You guys, this is being recorded. I mentioned this at the beginning of every single webinar. You guys watch this again. Why? Because it will sink into your long-term memory on some of these nuances. You can go out there and figure out how to do a long call spread. They're not going to probably go into the detail that I go into in these daily market or in these webinars because I have specific rules that we need to implement these types of strategies around. Okay, we're going to talk about strike location. You're not going to find those strike locations online, and I go into specifics as to, we're doing a debit spread here. What's the debit that we should be paying? What's our risk reward that we should be taking on here in a strategy like this? All right. So this is the roadmap to trading options. So I'm going to try and break it down, put it into simple terms that you guys might be able to understand. Like if we are going on a road trip, how we kind of plan out that trip. They say most people actually plan a vacation, spend more time planning a vacation than they do their finances. So that's actually what kind of got me on this whole road trip thing is, all right, if we're going to plan a trip and spend all this time planning a trip, you guys have got that down. Well, let's kind of correlate that to trading options here. All right. So it is going to be on the long call spread. We know where we're going to end up. All right. What I want us to do is play this out like we are finding an underlying that we have an assumption in, and then build it out to find the right strategy. So we're going to kind of take that out, try and put that in the back of our mind with this long call spread. All right. In the meantime, we know where we're going to get to, but I'm going to play it out like we don't know in the beginning. All right. Let's go over a couple of things real quick. Get this out of the way. My name is Eric Wilkinson. You very well may recognize me from mainstream media, where I've talked about the economic picture, the geopolitical environments, and how that impacts the overall markets. Well, I do the same thing in my daily market commentaries and in these particular webinars, but I layer on top of it these option strategies that we can use to increase our probabilities of success on those assumptions we come up with through, everyday life. I've traded everything from stocks, financial futures, commodities, currencies, and options on all these products in just about all market conditions. Basically started out trading in college, like I mentioned, with a psychology degree, and then switched it over to finance. As soon as I graduated, I moved straight to Chicago and started working on the floor of the board of trade there. You can follow me on Twitter at Wolfman's blog. You can also follow our parent company at ProTrader Strat. Facebook, you can find us on protraderstrategies.com. You guys, we're throwing out a lot of content on Facebook right now. So check that out because you can see those daily market commentaries. We're not throwing out every single thing that we do, but we do throw out some things here and there so that you guys can get a taste of what we're doing. All right. So check that out because there's tons of content on that Facebook page. It probably would help you, especially if you're watching those daily market commentaries, because, yesterday I was talking about, I just got nervous and started adding some short deltas to my portfolio, and all that stuff really helped out today. Didn't quite erase all the losses, of course, but it did help hedge that portfolio quite nicely. All right. So this is on the long call spread, but like I said, let's forget about that. Let's go over a couple of things. You guys know when we're going through a roadmap, right? We're looking at the map down here. There's all kinds of different colored lines, that's kind of designating a major highway, smaller roads, rural roads, different stops that you can go to. When you get a crossover, for instance, if the road, I don't know if you guys know this always makes me laugh because my wife did not know this. But if, let's say, for instance, you got a road that's kind of drawn like that and you're following that, you need to know whether or not you can get in on the corresponding road that is going to cross over it. So another road might kind of cross over. Well, if I want to get on from the red road and get onto that black road there, you guys know what needs to be there? Anybody know what needs to be there on that? There needs to be a little box. And that means there's an interchange. There's an exit. That's right. If you would need to know if I'm coming on the red line and I need to get over to this line here, well, there has to be a box over there. Well, those are just little things you find in that key that goes there next to whatever map you're looking at. Got a little sideways. I have a really funny story about traveling in Europe with my wife, and she was holding the map. This is pre-GPS stuff, and she didn't know that you needed a box there to get onto that next road. And so it was interesting because we were almost out of gas. All right, so our roadmap key is going to be delta. Now, these are the Greeks. These are the things that everybody's like, oh my God, he's going to be talking about Greeks, okay? Well, so I got my Greek letters here. We have alpha, gamma, theta, and vega. Anybody know which one of those isn't a Greek letter? It's vega. So yeah, vega. So delta. Delta gives us the effects of an option premium, okay? Delta affects the option premium, I should say, in relation to the underlying. What does that mean? So for every dollar move, it's basically every dollar move in the underlying, so in XYZ, let's call it, every dollar move in XYZ, that's how that premium is going to be affected by delta in the option montage. So let's go over to an option montage. And if you're not familiar, I'm going to talk about option montage a lot. And hold on, let me get my platform over here. So the option montage we got over here. So when we're talking about delta, we've got delta right here. And we're talking about how the underlying affects the options premium, okay? So right now it's at 24, let's call it $25. Can we agree on that? So it goes from $25 to $26, sorry, it's $205, and it goes from $205 to $206. So now we moved up $1, right? We can agree that it's basically, we're gonna call it $1. So we've gone up, it's increased by $1 in this case. And we can figure out what happened today with these option premiums as well. Well, it's going to be a little bit more difficult because volatility kind of affected them as well. But so for instance, what we're talking about is this delta here is 41 cents, right? So if tomorrow Clorox goes up by $1, just $1, all else changes. Yes, we're going to talk about theta as well. It's going to decrease the premium. But if we call this basically kind of landing somewhere in between, we're going to call this mid-market. Let's just, for easy math, say it's 580, but we could add it to both bids and offer here. 41 cents, it goes up by $1. Tomorrow, or whenever that goes up by $1, we could say it goes from 570 to $6. Let me erase that. Let's start over. It goes from $5.70. The bid would then be, goes up by 41 cents. It would be $6.11 on the bid, and the offer would be $6.41, okay? That's what would happen to those premiums on that first dollar move higher. Vega is a car, LOL. That's right. So for when it goes up by $1, the calls go up by $1. Now, if we look over here at the puts, we can see that the delta is negative, because the assumption with this rule is that it's a dollar move higher, okay? So if we went up by $1, then these premiums on the 200 calls would go down by 39 cents. So in that regard, if we went up by $1, this premium here on the 200s would then be, what do we say it's going up by, or going down by 39 cents. So it'd be $5.21 on the bid, and the offer would be $5.61, right? So that would decrease the premiums of the puts. That's because we're assuming plus $1. Now, if it goes down by $1, right, goes negative $1, well, then a negative plus a positive makes this a negative to the premium, all right? So then those premiums would have gone down by $1. Vice versa, a negative $1, we're talking negative $1 plus a negative delta. That means that delta becomes positive to the premiums, okay? So think of it that way. A negative plus a negative makes that a positive to the puts. a negative plus a positive makes that negative to the calls. All right. Vice versa, a positive plus a positive is a positive. Positive plus a negative is a negative. We got that. You can't see my screen? Can everybody else see the screen? Is that extrinsic value on toss same as the time value? Okay, everybody can see it. Visuals okay. All right, fine. All right, and hopefully my picture's coming through too. You guys got the video? Some people already shut that off. All right, so that's what we're talking about. And Tongue, I would have to say you're going to have to log off and log back in if the screen froze up on you. Sometimes that will help. And is it extrinsic value on toss the same as time value? Is the extrinsic value? No, time value is theta. All right. Extrinsic, I'll talk about extrinsic value in detail here in a little bit, give you a little bit. All options that are out of the money are extrinsic value. So for instance, this 240 call, I'll just go over it because you asked the question. This 240 call right here, that's all extrinsic value. Now, there is time value, of course, because time value of an option, decays away, all right? But there's also volatility added in there as well. So it's hard to say exactly what the time value is without doing the proper math there. You'd have to basically take the 3 times the 3 cents times the 36 cents or something like that to come up with your time value there. Off the top of my head, right? Don't quote me on that right now because I'm thinking you got me. I got to think about that a little bit more detail off shooting from the hip. All right. All right. So we've got that. So that's what delta tells us. Delta tells us the effects on an option premium in correlation to the underlying, and that's on the first dollar move. All right. The second dollar move, and delta tells us a lot of things. It tells us the probability of that option being in the money by 1 penny at expiration, on that expiration date. All right. So for instance, that same strike we were talking about, it was a 41-cent delta. Well, that means it's also 41% probability of being 1 penny in the money at expiration. All right. So delta, I like to think of as it's data because it tells us so much different stuff that I don't have time to go into, and I don't want to confuse everybody. I actually have a short video on just delta and talking about little option hacks that we came up with on the floor for delta, or just different option hacks in general. But delta is data. It gives you the data on that option premium and those strikes, okay? Gamma goes with delta. So gamma is the rate of change in delta. So what we're talking about here is the first dollar move, right? We're talking about dollar number 1. Now we're talking about dollar number 2. All right. So this is on the second dollar move. So what they're trying to do is help you understand what is going to happen with the different option premiums. So we talked about this going from 205 to 206, right? And down here, our premiums went from 570 on the bid. They went from 570 on the bid to $6.11, and on the offer, they went to $6.41, right? So that was on dollar number 1, okay? All right, that's where our premiums went to. Now, we're going to look at saying it's dollar number 2. So now we're at 207. So this was $1. It increased by $1, and I'm just going to go from the increase side, right? You guys should be able to figure out that same thing goes with the decrease side, that it's going to subtract away from that on the puts, right? The first dollar move, we lose 39 cents. The second dollar move, it's a negative to the delta. So this would, the gamma comes away from that delta as it goes further away, okay? So on the second dollar move, now we're at 207. So on dollar number 2, our premiums add in the gamma. So that first dollar move higher was 41 cents. Now it's going to be 43 cents. So on dollar number 2, our premiums would then be $6.54. And the offer would be then $6.95 or 90, what did I say? 2 cents, 43. So it's 44 actually, 94. So that gamma goes with delta. It adds into delta on that second dollar move. Okay. So gamma goes with delta is the easiest way to remember that. Now, theta. We've got theta coming up. Theta is the impact of time on our premium. So we don't have a DeLorean. We can't go back in time. The only thing that ticks away is, the only thing that's constant is time, right? I mean, it keeps ticking away. You can't stop it. So if you look at the chart here, or at the option montage, I should say, you can see that gamma is, theta is always negative. It's because you can't stop time. It's always eroding away at the premiums, whether it's in the money or out of the money, okay? There's intrinsic value for in-the-money options, and there's extrinsic value on those in-the-money options. All options out of the money are extrinsic, which means they can decay to zero. Intrinsic value is what it's internally worth. Think of it that way. So, you know, the 150 strike, what is the 150 strike worth? Well, it's worth $54. Why? Because the 150 strike plus $54 gives, or actually it's $55 because it's, we're saying that it's worth, this is 205 for the most part. It's worth $54.93, really, $54.93, because that's where it traded last. So this 150 strike, the intrinsic value of the calls is worth $54.93. Well, you can see they're trading a little, or $54.93. You can see they're trading higher than this. This bid doesn't have any intrinsic value in it. That's because there's nobody representing markets right now. So there's no way you would probably be able to buy that at $53.10. It'd be highly unlikely. Somebody would be giving up a crazy edge doing that. But everything else outside of $54.93 would be extrinsic value on those in the money options, right? So that's how you can figure out what it's worth, actually worth, without any extrinsic value. Theta ticks away. So tomorrow, nothing else changes. Volatility doesn't change. Nothing else changes. We would see the premiums decrease by 10 cents on the calls and on the puts. You can see it's all negative here. So that's tomorrow we open up. It's 104.93. Volatility is still, you know, unchanged. Nothing else has changed other than time decay, and those values on theta would erode. Theta is the thief, right? He never stops. He just keeps coming and eats away at your premium. So theta is the thief in the night that comes and steals your premiums, all right? So we can't stop theta. We can take advantage of it. Like, you know, if you buy something, well, you can offset it. But if you sell something, you want that theta to come in. And know that theta is more aggressive the closer to expiration than it is way out in time. Way out in time, it's like he doesn't know you really exist yet. And once it gets closer to expiration, he starts coming in and stealing more and more every single night, all right? Until he can take all of the extrinsic value out of your options. All right, here's our symbol for Vega. That's really, it's not a Greek letter, so I cheated. I used the small gamma letter because it looked like a V. It's the only reason why I did it. So yes, that Vega is not a Greek, but I did come up with something that looked like the Greeks, and it is actually the lowercase gamma Greek letter. So I cheated a little. But Vega measures the change in volatility. It's easy. You know, we had some volatility expansion today, you know, and, you know, you can be directionally right and have like short calls on. Like I had some short calls on today, covered calls, and the market started going down and those calls held on to the value. Why? Because volatility was offsetting the delta. And volatility is something you need to be very aware of. It's one of the things I trade around the most. All right. It's the thing that I really look at. We want to buy cheap volatility, which means that premiums are at their cheapest, right? When volatility is at its extremely low level, that means that, Tong, I haven't seen your screen, sir. Everybody else was telling me they could, so I don't really know what is happening. Are you seeing a trading platform right now? It's hard for me to tell when people can see it. I can only see like sound and video. All right, Alexander's saying that he can see the option montage. Everything looks okay. All right. Okay. I'm sorry, Tong. We're gonna have to figure it out. We're recording this, so it will be sent out, and the recording should be working. I'm seeing it's recording, so I know we're good to go there. All right. So volatility measures the effect on our premiums. Now, volatility is positive. Why? Because it's assuming that volatility is going to go up. All right. Everything assumes a positive move. All right. A positive day goes by. All right. Positive move in volatility goes by. Well, here we're looking at an increase in volatility. So when we look at it, we're checking it out over here, goes from 32.29 to 33.29. All right. So that means that these premiums, that's all else being equal. We're not moving a penny off of this strike location, but we just see that volatility move up by 1 percentage point. All right. It's 1 percentage point move. So 1 percentage point move, 25 cents would go into this premium. All right. So it doesn't move. We move up 1 percentage point, then these premiums would increase to $5.95 and then $6.25. All right. Vice versa. Same goes over on the calls. Those are the volatility would go into those premiums. Right. What does happen is if it goes down by 1 percentage point. Well, then we see that premium come out of it. They would decrease by that corresponding volatility. All right. Have him get out. I saw him log out. He logged out and logged back in once or twice already. Anytime you guys sound goes out or you guys lose the video, the best thing to do is log out, log back in. It's usually not on my end. I see it crash on my end if it really goes bad. So we do have that happening. And sometimes I forget to start the webinar, which kind of freezes it up on the homepage. So you guys have to yell at me if I'm like talking about, and we're looking at the option montage and you're like, dude, I'm still looking at the very first page. That means that was my mistake and I forgot to start it. I see you, but not this, seeing the screen. Oh, well, maybe my picture is too big. Shrink the picture. They're up in the upper corner. I think that you can move that picture around and just move it off or shut it off. You're like, your mug is way too big on my screen right now. All right. So volatility is assuming it's going to increase. 1 percentage point increase is the corresponding beta. It's a penny or it's penny increments. So 25 cents in these 210 calls over here is what we're talking about. 25 cents would go in there on that first quarter or first percentage point move higher. If it decreases, it's going to subtract, right? Negative 1% in volatility. Negative plus a positive is a negative to the premiums, and that goes across the board on the puts, all right? A negative to volatility is a negative to those premiums. All right, so we've got our key out. We know what that is. Delta, think of it as delta is just data. Gamma goes with delta on dollar number 2, right? Theta is the thief in the night. All right, Vega is just volatility, not volume, volatility, all right? And, you know, little fun fact, Vega is not a Greek. Yes, it's a Greek in option strategies. All right, where are we going? So now we got to plan out our trip. This is the idea. I want you to forget we're talking about that long call. Hopefully you probably have now. I've gone through all the key to the roadmap. But where are we going? The idea is here. Vega is a Chevy. Eric, at top of WebEx toolbar, click on icon name. Use 2 screens. Oh, sorry, KM. I just read that and he just logged out. All right, looks good. I thought I saw a couple of other questions. I'm trying to get to those questions before I move on too far. Size of the font. Okay, you keep gamma. Oh, do we keep adding gamma for each new dollar increase after the first or after the second dollar? Well, it starts changing after the second dollar. It becomes a little bit more difficult. You're going to have to look at it on a daily basis and start following it. It will adjust. You know, it's going to adjust as it happens. It's a little bit more difficult because you can see it's pretty close for the second dollar move, the third dollar move, the fourth dollar move. Maybe it starts getting a little bit, you know, further away. Gamma starts affecting it a little less. It's gamma and delta are the largest at the money, and the further away they start affecting it a little bit less. Okay, does that make sense, Cox? So it's kind of a ballpark figure on that. So you know, you kind of have to ballpark. You just know it's starting to thin out. And same with Theta and Vega. The further away the options are, the less it affects it. One thing I did mention was that volatility affects the further duration options more, the expiration options more. We can see that Theta over here and Vega are right here. Volatility is 25 here, but we go out 100 and some days, you can see volatility is much higher. For instance, when I said closer to expiration, Theta erodes faster. You can see these numbers are much higher than, almost twice as high as they are further out, 100 days further out. Okay, so volatility affects further duration. Theta is coming and stealing your money more and more every single night. All right, so back to where are we going? All right, so the idea here is we come up with a directional assumption. Now, I know it's, you guys are like, after today, I don't know if I have a bullish market assumption on anything, but I do. So let's just say I'm looking at the charts and I'm going through them and trying to figure all this stuff out, and I come up with Twitter. So I'm looking at Twitter, all right, and I have that in mind. I'm looking at Twitter, and so I'm like, hey, you know what? I'm kind of bullish in Twitter. So, you know, let's just say Twitter is out here in Never Never Land. I'm going to change the thing here. Actually, yeah, that's fine. Twitter. So we're going to go to Twitter, all right? And that's the location. The next thing we need to figure out is, you know, I'm bullish in it, right? So I know that I have to have my assumption on this. I'm bullish. I'm going to Twitter. I'm bullish. So in that case, let me just switch it out over here on my ink color. So we know we're going out here to Twitter, and I'm bullish. For some reason, I just did a brain cramp on Twitter. So we're going to Twitter, and we are definitely bullish on it. So we know we're going to at least go in this direction, right? If we're starting out, let's say in Chicago, you know, there's a lot of different ways to get there, and those could be different option strategies, right? So the idea here is there's a lot of different ways to get to where we're going, but we need to narrow it down, right? We need to plan this out and find the best path for what we want out of this trip, right? We might want to go and see some different types of, you know, roadside attractions. I'm the biggest tourist attraction junkie there is. I mean, I stop at every single one along the way. My kids sometimes are like, Dad, let's just get there. And I'm like, no, we've got to go see the world's largest ball of yarn. And true story. That's what I like to do on those road trips, driving out west. So we've kind of come up with a direction. We've got a bullish assumption. We need to know how we're going to get about getting there, right? So we're going to start narrowing that down by finding these things out. We know we're going to at least head north. I don't necessarily want to go south to get there. I want to go north. I want this market to go north. So we have our destination. We've got our directional assumption. Do we have, like, is Twitter even worth going? You know, I told you I'm the junkie that likes to have attraction. I like things to do. So is there enough going on in Twitter that is going to make me want to put a strategy around that? What do I mean by is there enough going on? What I mean by that is in Twitter, let's just go over to Twitter for the example. In Twitter, is there enough volume and open interest? Is there enough open interest, enough interest going on in Twitter for me to want to go there and implement a strategy around it? So what we're doing is we're looking at the option montage again. And what I have as a rule here, you know, all of my strategies, we're going to be looking at a red light, green light, stoplight. All right. So if it's a green light and I'm looking at a stock that's less than $100, all right. So I have a XYZ stock and it's less than $100. All right. I need to look at the option montage on the options that are closest to expiration. And in this case, 35 days is the sweet spot that we're going to be looking at. Then the option montage has to have the bid offers be less than or equal to 10 cents wide. All right. That's a green light. So we look down here and we can see right now that these are about 8 cents wide for the most part. You know, some of them are getting a little wide. This rule applies, is applicable during open market operations. We talked about this when you're canceling all your orders at the end of the day. Well, these markets change. They're representing whoever's crazy enough to leave something in overnight. So that's what we're looking at right now. So when you're kind of planning this out and following this rule, that's during open market operations when, you know, free market price discovery is in full swing. We want tight bid ask. We don't want to give up too much edge to get in and too much edge to get out. That eats away at our yield, at our overall portfolio. You know, if you're looking at $100 stock and they're like 25 cents wide to the bid offer, and you've got to give up 20 cents to get in, well, that probably means you're going to have to give up 20 cents to get out. Think about what we're talking about with theta. You know, it's only 3 cents a day. You know, we're talking, you know, 20 days before just theta. If nothing else happened, theta ate away with those premiums or whatever, right? So you have to plan for that, or you would have to have, you know, a move in order to make up for that in delta. All right. So we want tight markets so that there's people in there willing. If you bid up a little bit, somebody else offers a little bit, and you know, you're kind of like dickering over where you're going to make that connection and where you're going to make that transaction. Well, if the markets are really wide, that usually means there's one dude, there's one cat in town that's willing to do a deal with you, and he doesn't have a whole lot of incentive to make a better market for you because he knows you got to come to him. All right. So we want to have a lot going on because, you know, if, you know, one gas station's you know, like when you're driving out in the desert, that gas station's prices are, if I drive from here to Las Vegas, there's one gas station where literally it's almost $2 more a gallon in the middle of the desert because there's nothing else around. And if I can make it like 25 more miles, there's probably 10 more gas stations down there, and it's $2 less, right? That dude that's out in the middle of nowhere knows that if you need gas, you're going to have to pay that extra $2 a gallon. And especially if you've never been on that road, you're thinking, oh my God, I'm out in the middle of the desert. I got to get gas. I got to get it here. All right. So that's the idea, right? I want a lot going on. I want free market price discovery in full swing. So stocks less than $100, equal to or less than 10 cents, that's a green light. If we're looking at doing this and it's, 2 times the rule, meaning 2 times that 10 cents rule. In this case, it's a yellow light. 3 times the rule. 3 times the rule is a red light. Right? That's a red light. Now, if it is a stock that's over $100, we're looking at one of these over here on the side, like Netflix. You move the decimal 3 ticks to the left, 1, 2, 3, and Netflix should have it around 43 cents. All right. So look at that for that rule. Apple. Move it 3 ticks to the left. We should be looking at 34 cents, okay, for Apple, because we moved that decimal 3 ticks to the left. 1, 2, 3, all right, 30, 33, 33 and a half. You can round it up. Same would go for, those are green, and then 2 times the rule. 2 times the rule would be 46 cents, and 2 times the rule down here still follows through on my stoplight there, okay? 3 times the rule, move on. There's not enough free market price discovery going on in there. So MS is what's the minimum for open interest you would consider for any stock? All right. Now, this is my rule because it kind of implies there's a lot of free market price discovery going on. There's people falling over each other. They're making market. Now, we can look at open interest and, assuredly, generally speaking, I should say, not assuredly, generally speaking, if it's fitting my rule, it means there's a lot of free market price discovery going on. That means there's a lot of volume and open interest in there, okay? It usually follows hand in hand. I think that this is a better rule for people because you don't always necessarily have the volume or the open interest, but there's a lot of eyeballs on there and there's good markets. And that's really all I care about, is that there's good markets. Somebody is making a good market. It could be an algo. I don't care who it is, but at least somebody's making a pretty good market in there. So that I know that it's pretty tight. I know it's liquid, right? And when we see like big moves like we saw today, that rule gets expanded a little bit. You're going to be looking at a lot of yellow lights. Why? Because volatility is spiking. People know that, they have to offset that risk. The guy who's selling a call has got to, as a market maker rule, if I'm selling a call out there as a market maker, if you buy the call from me, then I got to go out there and buy the underlying, right? Because then I'm just basically hedging my risk. Or, if you buy the call from me, I got to go out and buy a put to hedge off that risk. However, that person's hedging or offsetting some of that risk. So in that, when markets are very volatile, he's like, okay, I've got to offer these options a little bit wider, because by the time I go over there to try and grab my hedge, the market's probably going to have moved on me. And I've got to bake that into the cake that, hey, I might not get the price that I'm looking at right now. It could be worse. So I've got to have a little wiggle room on these options. But usually if there's free market price discovery in full swing, you're going to see this fit into that rule. All right. Would 200 in open interest be sufficient, or maybe 1,000, maybe at a minimum? You could, I almost never really look at, I would say that if there is 200 open interest, it's got to depend, across the board. If it's just in one specific strike, right, then that means that it may have only happened at one time, right? Where we're looking at Twitter, this is really good volume and open interest going on, volume and open interest. Ford, we can look at that. There's really good volume and open interest. Almost everything I have over here is going to have pretty good volume and open interest going across the board. Aon's probably one that doesn't. Aon's pretty lax. You can see Aon has good volume as a stock trade, but Aon is dollar wide. I only look at Aon because I like the stock. It was a Chicago company that I had a friend that was president of, so I always watch it. But it doesn't fit the rule, and it almost never does, even during open market operations. So you can see there's no volume, almost no open interest. I don't trade options in Aon. It's way too wide. I don't want to have to chase it. This is one of those situations where I might have to bid all the way up to $7 to get in. And when we're talking about this, is that a good price? Unless you want to go through Black Scholes and all that stuff, it's neither here nor there. So I just stay away from them. I don't like to have to figure out all that stuff either, like I used to. That's one thing that I was like, you know what? When I start trading options online, I'm not watching that stuff anymore. All right, so that's what we're talking about. Is it a good destination? Does it have a lot of attractions, a lot of eyeballs, a lot of things to do? All right, there's a lot of open interest. There's a lot of interesting things to do. Think of it that way if it helps ring a bell. These are things I'm trying to do to try and make you guys remember. Is it a good destination? Well, that's that rule. If it's got a lot of things going on, less than 10 cents on stocks less than $100, that's good. 2 times the rules of yellow light. If it's over $100 stock, move the decimal 3 ticks to the left. That's what it should be. Amazon's $2,000 stock, bid offer should be about $2 wide. All right, $4 wide is yellow light. All right. What do you mean by, you said if someone bought a call from you, you have to buy a put to hedge? Well, you know what, John David, I was shooting from the hip there, and that really that would be that was a wrong analogy, I guess. I'd probably have to go out there and buy a call to kind of hedge that, right? Or buy the underlying. So buying a put would not hedge a short call. You're right. Sorry about that. I was shooting from the hip. I was trying to think of a way to hedge right off the bat, and that would not be a very good hedge. It's usually going out there and offsetting that risk somehow. If somebody, say for instance, bought a call from me, then I'd go out and bought a call from me, I got short, I'd probably go out and try and buy a call somewhere else, whether it's a calendar or something, like creating a calendar or something like that, or a diagonal. But you're right, you would not, thank you for correcting me on that. You would not go out and buy a put to hedge a short call. I was confused for a bit. I'm sorry. You know what? Sometimes, I'm just free flowing. I do make mistakes, and I thank you for actually correcting me on that, because that is not what we want. So I was going to draw on this page when we were talking about, is it a good destination? Basically, there's a lot of eyeballs on there, right? That's what we came up with. We got a lot of things to do. Kids are going to be happy, right? So that Twitter, we kind of determine is something that we can do. We're taking a bullish assumption on this. What's the environment? Well, in this, the environment is volatility, and we need to really understand volatility, how it affects those premiums. We saw something happen today, right, where I was talking about it. I had covered calls on some stocks, and I was trying to peel out of some of them, trying to think if it was on, I think it was on Disney, but Disney was taking a tank today, right? Well, my short calls were holding on to value. As the delta was eating or taking away my premium, right? That volatility jacking up, back up, VIX went up into the 40, and I didn't even see exactly, a percentage increase in my premiums, but that volatility going up was offsetting any directional down move in those calls. So we need to be very aware of what the environment is and how that's going to affect those premiums, right? And one of the things I talk about when we're going on a road trip, if you've got the nice sunny skies, right, there's no risk on the road, no risk on the road. There could be potholes and stuff like that. But the idea is there's no inclement weather. It should be free sailing. We can take our time getting there, right? So the idea here is when you have low volatility, you can kind of take your time to get there. Meaning, another thing is we can take the off-roads. We can go and see the sites where, right here, we can go and see the, what is it? The cheese palette, the cheese castle. And we're heading out west and go through Minnesota, and we can go and see the corn palace. That's what I was thinking of. We can go out and see Wall Drug. If you guys have ever seen that, that's a pretty fun place to go. And then we can go and actually visit Yellowstone. If it were something that was crazy weather, if we had crazy weather, we would want to get there fast. We would want to kind of just beeline it. We'd want to take my kids' route and just straight beeline it, no stops, try and get there and get through that weather as fast as we can. So what we were looking at going to Twitter, right? Well, Twitter, if we got to look at volatility for Twitter. And I should have said, what is the environment? Pulled up Twitter, kind of jumped ahead here. So let's go back to Twitter. So Twitter, when I'm talking about volatility, right? What's the environment? What's volatility? Implied volatility for Twitter is 60. Is that high or low? Well, we don't know. 60 for Twitter is completely different for 60 for Microsoft or 60 for Lowe's, okay? So what we need to do is understand how or what volatility is in relation to the underlying. Why does it matter? Why does 60 matter for Twitter when we're looking at the chart? We're bullish, I talked about volatility expanding on your premiums, right? Well, if we buy cheap, we're buying volatility in a sense, because when those option premiums are cheap, we buy them, and when they're expensive, we sell them, which means volatility is really high when we're selling. Well, when volatility is really low, we want to be buying premiums. That's why it matters. Volatility matters because as volatility increases, if we're looking at volatility here, or that, let's see if I can do my little volatility, my fake gamma, volatility starts increasing. That means our premiums start going up. They start becoming more and more expensive. That means if we bought a low and nothing else happened, we just saw this volatility start to spike, well, we could start seeing that positively affect our P&L, right? We could be directionally wrong. Like I said today, I was short calls. I was directionally right, but the volatility hurt me. So I was doing those short calls based on a different strategy. I was doing covered calls. So, that was a little different mindset on that. And I didn't really expect us to see massive volatility spike. I thought we'd see more of a ratchet down and not see that volatility. But volatility matters because we need to get into these strategies where it can, help us out. MS, I see your question. I'm just a little, I want to get through this. Let me get through this volatility part real quick. So as I mentioned, volatility affects the price of the option, which we talked about at the very beginning. We went over that, right? 1 percentage point increase in volatility affects our premiums to that corresponding beta. Beta affects longer duration options more than the near duration. That's kind of why I drew on the chart. Hey, we're going to take maybe the longer road because we want volatility. If we're buying to affect if volatility is really low, we want to be thinking we're kind of leaning now towards buying options, right? Because volatility tells us if it's really low, those options premiums are about as low as they're ever going to get. All right. And if options are, or volatility is really high, implied volatility is really high for itself, then we know those premiums in that underlying are about as expensive as they're going to get. It's not a perfect world. They usually stay, like we could say with Twitter, you know, before we started seeing this whole coronavirus and everything else, that options had a tendency to stay within, or the, you know, volatility had it, you know, a tendency to stay within that range in a sense. Okay. So, you know, the idea would be that when premium, when volatility got to these levels, we knew they were the most expensive they would be. And usually down here, we knew that that was about as cheap as premiums would ever get, because they usually stay within a certain range. Now, are we looking at a new paradigm where, you know, now going forward, we're kind of looking at, you know, that wasn't a very good line. Let's do this one. It's still not, it's wanting to hit the same place. You know, are we now within this certain range? And that's kind of what I'm thinking might be, at least for the next, you know, 5-6 months, is that this spike is probably, you know, a little bit overdone. That was like when we didn't know anything. Not that we know a whole lot more, but we do know a little bit more, and we probably are a little bit closer to, you know, recovery anyway. So this could be the new line in the sand for Twitter. So the idea here, what I'm saying is, you know, is 60 high or low? Well, to me, right now, going forward, implied volatility tells us where it's been in the past, but what we're seeing here is this might be the newer low, somewhere around 50 for Twitter, and then the highs I'm kind of saying is probably closer to 90-ish or something like that. So to me, it seems like volatility is a little bit on the lower end right now for Twitter. So that's why I'm leaning towards buying those, saying they're relatively a cheap buy for the type of environment we're in. Now, I used to just say it was pretty darn easy to figure it out. You know, we would basically use we can use the calculation where, and this isn't Twitter, I'm not really sure what this is right now, but we can see that the high here, let me just get rid of that. So and make sure I have on a good pen to see what color, ink color I got, because black is not going to work with this. So I'll go with red. All right, so we can see where implied volatility is currently. We can see that usually it'll break below every once in a while, but we can see that, you know, 25 is pretty low for this XYZ. Let's just call it XYZ, all right? This underlying XYZ we're looking at. 25 is usually as low as it gets, and it usually doesn't get a whole lot higher than, you know, 65, all right? So right now we're at 52. So the thing with this is we take where the current is, current implied volatility, current IV percent, or implied volatility, or finding out implied volatility percent, minus the low IV, implied volatility. And we take that sum and we divide it by the high IV minus the low IV. All right. So we take those sums and it gives us implied volatility percent. The idea here really is, and we can kind of eyeball it, we want to figure out where this mark is in relation to everything else, because that kind of tells us, volatility really tells us where the premiums are. You know, if you didn't have any volatility in these premiums, then I can't remember who it was asking about, is it all time value? Then yes, then it is all time value. All right. And that's where theta is coming in. But volatility can affect the premiums much more rapidly than anything else we have going on in the option montage. So we need to be aware of it. If volatility doesn't change, then we, you know, we got into it at the right strike locations anyway, and everything else follows into suit. But one of the things we're going to really lean towards here is we got to figure out if this banana is worth normally $1 or if I should be paying $5 for it, right? If it's stuck on the wall, you got to be paying like thousands of dollars with duct tape. But the idea is, you know, we're trying to figure out what the value of this is. And if we don't know, we need to look at, we need to know if it's cheap or expensive, I should say. So we know what the price is, but we need to know if it's cheap or expensive. And the only way to look is to look back in time. And we don't get to see all those option prices back in time because they've expired, right? One of the easiest ways to do it is look at volatility, right? If volatility is super low for this pin, then I know that this pin is about as cheap as it's ever gotten. But when volatility is at its highest, then I know that this pin is super expensive. It is kind of how we want to correlate that. So in this regard, the current IV is 52 minus that 25, I'm just going to say. And we take that sum and we divide it by the high, which let's just say it's 65. I don't know the exact number. And subtract that by 25, right? So now we've got a total of 27, and we're dividing that by 40. All right, which equals, somebody could come up with that real quick for me. What is that? I'm trying to do it in my head real quick, and I can't. I'm having a brain fart. It's like 50, 40. I'll just do the math. It's up above 50. Somebody probably else has it. So what do we got? 27 divided by 40. 67%. So we're looking here at 67%, which means, you know, it's above 50 anything. Thanks, John David. A couple of questions popping up here. Do you have a TOS script for the IV percentile? Great question, Prasad. I do. I have the script. Write us at trading at protraderstrategies.com. We can get that. All right. All right. So 67%. Now, what does that mean? That means they're starting to get kind of expensive here, right? So my rule here is for the volatility here. What is volatility? Is it high? We sell it. Well, basically what we're looking at here, if it's greater than 50%, we start looking at selling premium. If it's less than 50%, well, that's when we're looking to start to buy it. Now, Prasad was asking about the script, which I have, and you can put it in your watch list. You know, I have it where you can put it over here in the gears, you customize it, throw that script in there, and then I have it sorted from high to low. So this Twitter is telling me, and it's adding in this big spike here as well, but it's saying it's at 25. So my idea here is it's less than 25%. Also, if we drew the line here and did the math on this, said the high is 87, the low here going forward is 50, you know, we could easily see that, you know, 10 divided by, what did I say the high was? 87. 10 divided by 40, you know, I'm basically at the 25 percentile there. So I'm willing to go with that. Also, I also think that volatility looks like it's getting ready to expand a little bit. Now, yes, somebody could say, well, when the market moves higher, we're doing a long call spread. Usually volatility comes out. Well, we just saw recently on this particular rally, we were seeing, you know, in and around this rally here, we were seeing volatility spikes because volatility is a product of people buying options. Whether you're buying puts or you're buying calls, what happens is if you're willing to just buy those offers and gobble them up, well, those prices start going higher, you know, and if the prices are going higher, that's a product with Black-Scholes of creating volatility, all right? As those premiums become more expensive, that means volatility is going up. Or if volatility is going up, we know premiums are more expensive, all right? So volatility, the thing I love about Black-Scholes is it's like, is it the chicken or the egg, do all of the inputs find the price, or do the inputs create the price? I think the inputs create the price, because a lot of times when people are buying options, they don't care about Black-Scholes. All they care about on the downswing is buying puts, and they're just giving up edge after edge to buy those puts because they're fearful. Fear is volatility. It's the unknown. It's raining outside. People get a little nervous when it's raining outside, whatever. So market really starts moving higher in that. All right, we're seeing premiums get jacked up when we see that. So we want to buy the premiums when they're cheapest. Implied volatility percent is the best way to really figure that out. Figuring out where that underlying implied volatility is in relation to where it's been in the past. Because like I said, Tesla's volatility, implied volatility in the option montage is completely uncorrelated to what's going on in Procter & Gamble. All right, so you got to look at Procter & Gamble's volatility and where it's been going. All right, so we're leaning towards buying it. We know volatility is low. We're leaning towards buying. We want to limit that theta decay. Where is theta decay? Where is that thief not really gobbling away at our premium? Further out on the option expiration. So out here is where we're going to be looking, right? These are the days to expiration we're going to be looking at. These are at the money, so we're going to be dealing with in the monies and stuff like that, and some at the monies, depending on where we want our strike location. But the idea here is we don't want this happen. If we're buying something, we don't want to see this decay happening that fast. We can see a 50% drop happens 35 days to expiration. So right now, our option montage is showing right around that 35 days to expiration. That's about as close as it gets. So we want to go out here and buy somewhere around the 70 odd days to expiration. Why also? We talked about buying. If we're buying, we want to be buying some volatility. We want volatility to help us. And if volatility affects the further duration options, we want that to help us with our strategy, so that if we are directionally wrong and volatility starts spiking, well, it offsets that delta wrong move, right? So that's what we're going to be looking for. So we're going to be looking further out in time, all right? So what's the vehicle we use? Well, let's go over this. We talked about, we've got a bullish assumption. We've got the good underlying. We've got the good underlying with a bullish assumption. Low volatility, roads are clear. We want to take the long path, which means longer duration. Cheap gas so we can drive all over the place. We're going for the long call, right? What spots do we want to visit? These are our strikes. What strikes do we want? I usually like to do the in the monies, all right? Now, we've just had this big sell-off, and if I was going to implement this around Twitter, I might start leaning towards those at the monies just because I don't want to risk very much money on it, right? But if you're using the in the monies, all right, we're going to use the 84 delta option. That's the in the monies, all right? And then what we want to do is create basically a synthetic long, all right? So it's going to create like a long strategy, all right, that has limited risk to the downside. It's got a synthetic put in it. Why is there a synthetic put in it? Think about it. When you buy options, you have the right but not the obligation to buy that underlying at that strike. If my strike is out of the money, well, I don't have to take the stock at that price that's above where the underlying is trading. So I'm out of all further obligation below, but when I buy it, I can always say, hey, you know what? I want to take those stock from you. I want to get long at this strike. Yes, you have to pay for that, right? You have to pay the extrinsic value for it. It's going to match up where the current underlying is trading, but at the end of the day, you have the right, but not the obligation. So if it goes below that, you're out. It's kind of like a synthetic put. I don't want them anymore. You just let it go. I just leave them on, and they expire worthless or whatever. So you have no more risk below that. So it's kind of like a synthetic put. And then, we're selling a call against this because it's a call spread. We're buying an in the money call, selling it out of the money call. Well, we have limited risk to the upside. All right. But that short call pays for the extrinsic value. So we've got to set this up to where we are doing this to pay for the extrinsic value. So let's say, for instance, in Twitter, we're not using the 36 days expiration. We're looking at to make sure it fits my rule, right? That's the less than or equal to 10 cents wide. Now, I just talked about we want to get further out on the time horizon. So outside of 70 some odd days, 36 days tomorrow, 35 days. Thief in the night is coming to steal your premiums tomorrow. He's going to ramp it up. All right. So we're trying to look at the in the monies. There's two ways to do this, and I'll go over both of them real quick. We're using the in the monies and the out the monies. So if we're going to look at delta, I see your questions popping up. Give me one more second. Why the 84 delta? Is it that it's one standard deviation move? John David, you're on it. It's exactly why. We picked those 84 deltas because that's the one standard deviation move to the downside. Outside of that, I don't want to be in it anymore. John David knows I love one standard deviations. All right, so we're looking at the 84 delta. That's usually my go-to. It's the 25 strike. Now, we know that the 25 strike, $9, you add $9 into the 25 strike, that puts me at $34.25. Well, you can see $34.25. The underlying's trading 33. Wolfman, why would you do that? Well, there's extrinsic value in it. And now we know there's about $1 of extrinsic value in it by just doing that quick math. Well, you start dealing with the higher strikes or the bigger underlyings, it becomes a little bit more difficult when you're talking about like $58 in intrinsic and extrinsic values in these options. Well, here's an option hack for you. In the money options have intrinsic value. That's what it's worth. I know that this underlying is only worth about $8, right? Because 25, my strike, 25 to the 33, that's $8 difference, right? Well, this is saying $9. It means that this strike is really only worth $8. So there's about $1.15, $1.25 pumped into there. Well, here's the option hack. You look over at the corresponding puts of your in the money options or corresponding option. The puts kind of tell you what the extrinsic value is. It's not perfect. It's off by a couple of pennies. But, when you don't have to do all the math, I'm all about streamlining processes, right? I'm looking at little hacks so I don't have to think all this, do the math, punch up my calculator. My brain's already dead at the end of the day for doing math all day anyway. This is just a way to not have to do some math. So I just look at it. The calls, I want to buy these in the money calls, the 84 delta. You look over here, that tells you what the extrinsic value of the option is on a ballpark. So I'm just looking at that. I'm going to say, you know what? I need to sell at least that. Usually it's a little cheap. So I'm going to, I know from experience, I'm probably going to have to move down just a little bit. All right. So I've got the in the monies. Now what do I want to do? I want to figure out my break even in a sense. And if I add the $8 in there, I'm right there at $33. As a matter of fact, you can see I'm actually about 10 cents below where the bid is. That's another beauty in this strategy. When you build it out, remember I talked about you're synthetically buying this stock, right? We're buying an 84 delta. That means for every dollar move higher, my premium increases by 84 cents in that regard. Well, we are losing some on the short call as well, though, but we don't have any more risk to the downside, the covered call in a sense. But these in the money calls are going to still increase by 84 cents. And you can see that the further they go in, the closer they start matching up to what the underlying is doing. So we're kind of creating that synthetic long with a put. We've got a put in there because I have no more risk. This underlying goes below 25, and I wouldn't expect you to hold on to this going below 25 and take all that risk. But the idea here is you do, if it opened up tomorrow at 24, then you know at least your risk is limited there on that downside. But, you know, when we're selling this call against it, we also have limited our upside potential. Now, the rule for this, when we're picking this in the money and the out of the money, or the in the money strategy, you're using the 84 delta, okay? I need to make sure that I am risking one to make one, all right? And I'm paying $8. That means I need to make sure I'm making at least $8, all right? Risking less to make more is okay. But in this regard, I want to make sure when you're picking that 84 delta, you're risking one to make one. And you can set it up where it doesn't work out that way. So this is another way to just make sure we're doing all the right things here. So it is $16 wide, right? So $17 wide. Yeah, $17 wide. Final answer. $17 wide, $8 we're paying for it. We're risking less to make more. So that makes my strategy work, right? I'm risking $8 to make $9. I do that right? It's the end of the day. My math is like making me second guess myself. 17, $8. So yeah, $9. So we're doing well in that regard. Yeah, $17. Yeah, so we're risking $8 to make $9. Yeah, final answer. So that one works. So when you're picking the 84 delta, a couple of things. When you're doing that in the money, we're looking for the 84 delta. It's one standard deviation. We want to sell the call against it in order to pay off that extrinsic value, all right? We want to buy that underlying for its value. So we're kind of buying the stock where it is right now, but using a lot less margin. The other thing we want to make sure when we're building the strategy out is that we're risking one to make one, okay? It makes it appropriate. It started going against me on this strategy. You know, why did you get in? You had a bullish assumption. Well, maybe it's because you were like looking at this spinning top doji right here, or the 50-day moving average. Well, a rule here would be that if you were bullish on this because of that spinning top, if it broke below today's low, you would be out. Well, that's where I would expect you to get out of it. That's how you go in and set it, coming up with your bullish assumption. Maybe you're looking at it where you're just saying, you know what, it's kind of in this trend channel here. Not a very good trend channel, but you get the idea. It breaks below the trend channel, I'm out. Okay, whatever those rules are, stick with that. Breaks below the Fibonacci here, where you got this, it breaks below 32 because that's where that Fibonacci is. Then that's where you get out. Okay, and that's how I set up mine. I can't tell you guys exactly where to do it for yours because that has to do with your risk parameters, right? And one of the things I can't say is what your risk parameters are. And how much risk you should be taking on this. So there's a lot of things. I have a friend that says, if this strategy doesn't start working out in 5 days, that's where I pull the ripcord. He has a time stop on everything. So that is something you guys will have to, figure out on where you want to take risks. Now, if we're doing the at the monies, we need to risk one to make two. All right. So if we're buying the 34s that are at the money here, one of the things I need to look at, what's my collection here? I'm risking $3.50. Well, that probably means I need to go about, what is it for risky? I probably got to go about $10 higher. If I'm just looking at, I'm trying to do the math, three times whatever my premium is is about where I'm getting out. Well, 3 times that $3.50 is about $10, because I know that I'm going to be selling something to collect a little bit back. So I'm buying the 34s. I'd probably go and look to sell to build this out, the 44s on this particular one. So I've got $10 wide. I'm a little bit better. So I'm basically $2.50 on a $10 wide. I'm risking 1 to make 3 in this regard. So I might even say, you know what, I'll go in a little bit tighter and try and tighten it up a little bit. So you can do that as well. So now I've got $8 risking $2.25. I might even start ratcheting them down. The minimum I'm willing to do is risk 1 to make 2 on that. All right. So that's kind of what I want to do. If I'm risking $2.25, then you know, I need to make at least on this, have my max profit be like $7, $10 for the whole thing, and $7.50 or something like that. So probably should be about $7 wide. 6, 7, so 41 is probably the right strike. Pretty close. Oh, let's change it this way. I know I'm going a little long, you guys. I'm sorry. So $2, I got $7 wide. $2 to make $5. That's much closer. Risking $2 to make $5. Okay. From the current price, the short strike is only a $9 move. Yeah, it is. And, you know, it's only it moved $2 today. You're right. But it's also in the next 100 days. Right? A $9 move in the next 100 days is not too bad. Oh, for the in the money setup. Yeah, but, you know, the bottom line is if it moves up there and clicks it, like on the in the money one, when we're looking at that one where we were doing $1, which I think was this strike, right? Is that what you're talking about? It's only a $9 move, but think about it. If it's a $9 move, my premiums are going to get jacked. I mean, to be honest, I'd be happy in the next 100 days for it to come up there and hit that because I'm going to be very close to my profit potential on this. You know, because I'm really only wanting to get it. I'm not going to ride this into the end of the day and try and get that full $9. I'm probably going to get out of this for $4.50 winner. So when this is trading at $12.50, that's where I look to get out because I want to get out 50% of max profit on this. All right, let me get a couple of things also out of the way because just a little review here. All right, so let's go over this real quick because I'm really dragging this out long. Our direction, right? We need to know what our direction is. We need to have our assumption, right? All right, we need to have our assumption. And in this case, it was bullish. Our destination, we need to know if that underlying is going to be, is it fitting the rule? Is it less than or equal to the 10-cent rule or moving the decimal 3 ticks to the left, right? You know, on a $100 stock, move the decimal 3 ticks to the left, or $200 stock to equal 20 cents, right? Our environment, we want low implied volatility percent, IB percent, okay? And remember, every implied volatility, they're going to have implied volatility over there on the side. You need to know where it is in relation to where it's been in the past. Duration for the long call. We want, we want a greater than, I'm just going to say, I'm going to say we want greater than like 60 days to expiration, all right? At least greater than 60 days to expiration. That gives me enough time to stay away from 35 days. Because really, I only want to be in this for a couple of, if I've come up with a market move, I want this to happen relatively quickly. I don't want to necessarily be in this for the next 100 days. I'm just doing this so that volatility will help me out. I know way out there, volatility is going to help me out way out there. I know that theta isn't going to hurt me as much. That's why I'm giving myself enough time to be right on a long call strategy. That's why I'm getting way out there. And our strikes, 84 delta on the long call, right? And on this one, it needs to have the premium. We want to risk one to make one. Risk $1 for every dollar we make. Make a dollar, right? And then if we're at the money, we're doing the at the money, we're going to risk $1, and make 2. Okay. Now, why risk 1 to make 1 on the in the monies and risk 1 to make 2 on the other ones? Well, the one that is in the money, we have a higher probability of success. So whenever you have a higher probability of success, it's kind of like you're flip the coin or you're 50-50 on it. If your probabilities are higher, you're not going to be able to make as much on it. Now, this one, the at the monies, your risk is higher because your probabilities of success are quote unquote less. So we need to be compensated for the probabilities being against us, okay? On that. All right, so real quick, I've gone over these things a little bit. Our max profit is going to be the width of the spreads minus that premium. I kind of went over that with the risk reward, right? Our max profit is that, and that's at expiration, you guys. That's if we rode it out into the sunset on the very last day where those options expire. Our max loss is the premium. That's the beauty in the spread, is that we know what our max loss is on it. And our break even is the long call strike, and I went over this, plus the premium paid, right? The overall premium paid is our break even. Now, I mentioned that before when we were looking at the spread. One thing we want to make sure of is that when we add the premium in to the long call, that we're kind of at least around where the underlying is trading, because that's where our break even is. I don't want to buy this underlying where it's above where the stock is trading right now. I kind of want to build this strategy out where I feel like I'm getting a good deal. Everybody else is buying Twitter at $33, and I'm buying Twitter at $32 and like 90 cents or something. I feel like I'm getting a deal there, which you are. You're actually buying it below where everybody else is, because it is going to act on those in the money calls like the underlying. I see questions coming up. I'm going to get to that here in a second. All right, so we know we've got the Twitter. We've got Twitter, right? And we know that we are looking for it to get out at around that 40. I think what did I use? The 41 or the 42 calls, short calls. So that's kind of where we want to get out. So we know our exit. Our winner, though, we're looking at getting out of 50% of max profit. All right. And that's, on something like these big dog ones, I'm risking $8, get out on a loss, at a 50% premium reduction. Right? I can't tell you this isn't a hard rule, but that would be something you could look at. You could also say if it breaks below the Fibonacci, if it breaks below my setup on my charts, okay? All of those things, that's going to be one you guys are going to have to search your own brain for, okay? So, that really is a hard nut to crack, because I can't give investment advice. So that's one of those things where it's kind of like it has to do a lot with your risk parameters. But 50% of max profit is basically where I'm getting out of it, all right? I'm looking to cover this trade when that market has gone up and either if it kisses my short strike call, I'm pulling the ripcord out of it, all right? I don't care where the premium is. It's most likely going to have reached or probably breached this rule of the max profit, but I want to get out at 50% of my max profit. So in my case, my max profit is $9, right? I paid $8 for this spread. My max profit is $9. I'm getting out for $4.50. All right, well, you got to remember I got that debit over there that I paid $8 for. So add that $4.50 in. So when I can get out, it's trading at $12.50. That's where I'm getting out. Okay. All right, let me try and answer these questions real quick. Won't the 84 delta probability of being, yes, the 84 delta has an 84% probability of being in the money. Yes, absolutely. Won't a calendar or a diagonal be better instead of the long call spread? Well, it depends. I mean, you know, if you can set it up, you can set it up where the diagonal, and it kind of depends, you know, if the diagonal gets the move happen really fast, then no. That's the problem with the diagonal, or especially like a calendar. Like if the market moves quickly, you know, like for the setup where I'm looking at, where we've got a spinning top doji, I'm expecting this market to kind of pop like that, right? You know, one might say on that basis of candlestick trading. So if you're expecting a quicker move, you know, you got to be pretty bullish with this one. Then this one would actually work out better than that diagonal. All right. Generally speaking, not always. I saw another question. MS, I see yours. I want to make sure I got everybody's. In the monies I got. Why or how do you pick the short 42 call for Twitter? So my idea for that one is I want to build it out where I'm risking one to make two. So, you know, I was paying $2. My idea is, you know, the width of the spread. I pay $2. I've got to at least be able to get out of this strategy at $6, you know, my max profit would be $6. So in that case, you know, you're looking at about an $8 wide. Okay. Does that make sense? So I was kind of shooting for that. I want to risk one, so $2, so that I can make actually $4. That's probably why I was doing the math wrong on that. I'm risking $2 so I can make $4, so it probably would have been closer to $6. That's why I was risking one to make four in that case, because I was thinking of it wrong. But usually when you're building that strategy out, you pull it up and you see you're paying $2 for it, then know that, well, I'm risking one, I need to at least make two. That's a $4 profit, so it's got to be about $6, $7 wide in a sense. So I was shooting from the hip there. You know, when I'm trying to think of a lot of things going on, there's a tendency sometimes get a little funky. And I was making mine a little bit wider, so I was risking one to make four. Probably should have tightened that up a little bit. Only to make what the calendar only make use. I think I answered your question there. How to further explanation: the higher the volatility, and we want to buy when the volatility. Knowing the further expiration. Knowing, I don't know where you went with that. I'm going to read the last part of it. The higher the volatility, okay, and we want to buy volatility when it's low, yes. And when would you want to buy 1 to 2 day versus 70-day expiration date? I don't know exactly what you're asking there. When you are using near duration, you want to be sell. That's, you know, like if we had high volatility, then I'm probably going to be leaning towards selling, right? And how do we take advantage of that? We would want to go to closer duration because I want that data to kind of eat away faster because I'm selling. I want to buy it low, right? I want to sell when it's high volatility and buy when it's low. Volatility affects the further duration, so I want to get out there and buy when it's really cheap. Does that make sense? Can you show in a normal distribution curve where the current prices of one standard deviation in the money are located? I can't. I mean, unless you want to see my ugly drawings, like, I mean, I could do a, like that. So usually with a standard deviation, this is where current XYZ is trading. And in our case, it was 33. You have a half standard deviation here, which is about it's about a 34 delta. And then, the one standard deviation move is about a 16 delta, right? Now, why am I saying 16 rather than the 84? Well, because, that's on the put side. All of this means, one standard deviation here, there's only a 16% chance of it happening here, and then an 84% chance of all of this happening, right? All of that happening. So in a sense, when you're talking about a one standard deviation, they're going to usually say it's around a 16 delta. Well, that's what's the opposite of that. Well, it's a 16% chance of this happening, okay? And it's an 84% chance of all of this happening above. Does that make sense? Okay, that's how that whole 84 delta thing happens. Yeah, 84 delta, 84 delta is equivalent to a one standard deviation move. It's because, in a sense, if the underlying's trading here and I'm buying this as the 25 calls, right? I'm buying the 25 calls. It's on this side. It's basically in the money. All right. And if I say this is a one standard deviation move, well, then the option strikes are saying, well, you've got 84% probability of that happening. Now, remember that 84% probability is that in the next 100 days, the underlying is trading, there's an 84% probability that it's trading above $25.01. Okay, because that would still mean it's in the money. Okay. Oh, perfect. You were confused about the 16 delta and stuff. Yeah. So that's the idea of the distribution curve there. All right. You guys, this is the offer we've got going on. I'm going to throw it over into the chat window for you guys. This is a great product, you guys, that we've got going here. This is the Options Lab. This is a new thing that we have going on here. This is also the link, but like I said, if you're watching this online, go over there and click on that for me so that you can pull up the web page. It's got so much content, like it says here. There's over 100 hours of video content in there. So I would be just scrolling down the web page on this. It's got access to the entire course with over 100 hours of content, you guys. First 100 members will be charter members. We're actually less than that now because I offered this last week and a lot of you guys took advantage of it. So thank you for that. But the first 100 members will become charter members of the Options Lab. You guys will receive automatic upgrades to VIP status, which means that you guys get access to future content and promotional discounts, all of that jazz. You guys get access to that. Most people will just get access to the promotional stuff when it's happening. You guys will still get that. You'll get the questions and answers office hours. If you guys want to reach out to me, you have a question about a strategy that's going against you or something like that, I can tell you what I would do according to my rules. I can't tell you exactly according to what your risk parameters are and stuff with that, but how I've set these strategies up, how we can stay mechanical. I'll walk through it and how we can do that. And you can get it all for $97 a month, which is a bargain for all of the content that you guys are going to get. Alexander said he did it yesterday. Thank you. So take advantage of that. Scroll through that list. You'll see all kinds of good stuff in there. One thing you also see is a long call spread, where I've done a long call spread, maybe according to implementing options into your portfolio. So you guys drive the content. some different people were probably involved in that webinar, and they might have asked different questions that you didn't get to, or I just didn't see as they were scrolling off. So make sure you check that out and take advantage of it. JQ said, running low on gas, getting off next exit. Thanks. Have a good weekend. Take care, JQ. You too. Have a good weekend. Was second confused. Okay, so I answered that one. All right, perfect. Great, guys. All right, thank you guys all for sticking around a little bit longer. Like I said, this is over there in the, if you want to look at all the different things that we have to offer, it's a little bit more than what we have there on this page. I want to thank you guys all for attending. There also is the link again, but please remember to go over our disclaimer. There is risk to losing money while trading. So see a couple of things popping up. I did check to your predictions of your previous webinars, and they were good. Thank you. See, not too bad. I'm not always wrong. If you guys watch the daily market commentaries, yesterday I was like, I'm getting short Boeing because I needed to add short deltas. I was overall long. I added some SPY puts buying, and those worked out quite nicely. I was like, I think SPY we're going to kind of pull back a little bit here, head down to 3,000 in the SPUs. I didn't think it was going to happen today, but it did. So that helped out quite nicely. So you guys should watch those daily market commentaries. They are not investment advice. I'm not trying to get you guys living off the cliff, but what I'm trying to do is show you guys how to, on a daily basis, what I go through. I mean, I'm trading every single day, and I follow these rules. I stay mechanical with it. I do covered calls on stocks that I've owned. You know, if I sell puts and the stock gets put to me, what do? I stay mechanical. It happens to all of us. All right. Not every trade is a winner. And today I talked about some losers where I was pulling the ripcord on it. You know, if I had travel and leisure in my portfolio, it was getting axed. So, I don't know. Did I pick the right time to get out of them? I don't know. Who knows? I don't care. I'm just doing what I do. And, you know, you guys can see that, you know, this is what we all go through on a daily basis when we're trading. I'm not just going to cherry pick my winners. I talk about the losers probably more than I talk about my winners in those daily market commentaries. And you get that with the deal we offered today. So make sure you guys take advantage of that. I see a couple other things. Have a nice weekend. Great webinar. Thanks, MS. Appreciate it. Thanks, Eric. You might wonder why I attend so many webinars. I'm getting to get all of the concepts drilled in. Hey, no, exactly. That's John David. That is exactly what I talk about at the beginning. I was like, watch these webinars again. Watch them over and over. You're right, because why? Every webinar, you know, even if you watch the long call that I've had before, if you guys been around for one course and going into the next, I try and talk about these a little bit differently, and hopefully that it starts clicking with you that way. Also, the more and more you review and go over this stuff, it becomes more and more second nature for you, and you'll start remembering it. You won't even have to think twice about it. I love the monkey and bars, by the way. Nice. What go up needs to go down, and what goes down needs to go up. That's right. I agree with that. No response there. You teach the concept the most easy way to understand. I appreciate that. Appreciate that. Thank you very much. All right, guys. Oops, there we go. All that stuff. There we go. Take advantage of the option lab, boys. All right, and girls. You guys have a great weekend. Bye for now.